So we're in the US earnings season. As I speak, we're about 60% of the way through the S&P 500 reporting. What does the scorecard look like so far? Well, thus far it doesn't look too bad. We've had a small upward surprise on sales, top line growth. That's about a 0.5 to 1% upward surprise. And we've got about a 3.5 to 4% surprise on earnings. So one, that's presumably quite positive, and it also means that implies that margins are actually holding up reasonably well in US corporates, and this is despite the fact they're coming off multi-year highs. There are, of course, mitigating factors. There is always a certain amount of bait and switch going into the earnings season. Analysts are quite prone to trimming their earnings forecasts and then say, yes, we've beaten forecasts when the print actually comes in. And there's certainly an element of that there. I would also point out that on a 12-month forward basis, a rolling basis, we have seen some deterioration in the earnings forecast of the order of, maybe 1% or so. But, certainly not the sort of earnings recession that we saw in the US in 2015-16, which ultimately helped lead to a stagnant market over that period. It's also important to contextualize what's going on in the US earnings season relative to the picture elsewhere. And there, and again, this cuts back to the broader macroeconomic picture, US growth is, of course, expected to decline somewhat during the course of 2019 from where it was last year. And we're talking about something like, a 2.9% growth rate, 2018, coming down to about 2.5% this year. Elsewhere, we're seeing perhaps more dramatic slowdowns in growth prospects, particularly in the Eurozone, and this is being reflected in the earnings momentum that we're seeing in those regions as well. So we can say, well, do you know what, there are some downside risks to the earnings outlook for the US, but there are probably even more downside risks to other regions. And of course, one of the key calls by equity strategists this year is that we're going to see international equities perform rather better than US equities, and a lot of this was due to relative economic momentum, relative earnings momentum. And as I've mentioned, that hasn't necessarily panned out thus far. Certainly, we've seen emerging markets do very relatively well. This, in large part, is due to the Federal Reserve last week effectively capitulating on its hawkish forward guidance. That's caused credit spreads to come in, and it's certainly supported emerging markets. But that doesn't necessarily mean that we're going to see a wholesale rotation from the growth stocks in the US into more value-oriented stocks elsewhere, again, particularly in the Eurozone. So, I'm sorry to say that once again, I'm going to be a contrarian. I don't necessarily feel that we're actually positioned, at least at the moment, to see a significant outperformance of European equities over the US. Thus far, there seems to be a reasonable amount of validation in the US earnings season to support that particular hypothesis. Let's see how the rest of it turns out. And of course, let's see how the European earnings season, which itself is only just starting, let's see how those numbers look. I think it could well be that we're going to see some pretty disappointing numbers for the fourth quarter and also some pretty wary guidance for the coming year.